Now to the staggering move by the Bank of Japan's policy change that rattled investors around the world today. The BOJ deciding to allow the Japanese 10-year bond yield to move a half point to either side of its 0% target. The bond yield spiking, now up 63% over the past week. The move sending the yen to its highest level against the dollar in months. Our next guest believes the greenback will continue to weaken and take U.S. stocks along with it. Currency expert Jens Nordvig runs Exante Data. He's here to talk about the yen. Jens on the yen.
We
couldn't.
You had to expect this from us. Come on, Jens. Man, this is
never heard it before.
How significant is this?
So we've had essentially zero interest rates around the world, right, since 2009. We've been coming out of it. Japan was the last country in the world, last significant country to start to move away from zero interest rates. It's a big, big deal. Japan is a big investor in all kinds of markets, especially fixed income markets around the world. And we can see when there's a shift in Japan, we've essentially had all yields globally shift up today from Europe to the United States. So it's a big deal. And it's not just today, right? This is a signal that they're going in a certain direction. There's going to be almost guaranteed more steps in 2023 from the Bank of Japan.
It's almost guaranteed. So what other steps could we be in for if this is just sort of like the toe in the water, so to speak?
So today they stopped anchoring the 10-year yield, right? And they have not done anything with the short end yet. Like, we still have effectively like minus 10 basis point interest rates in Japan, right? So if inflation is around 3, all the models we have tracking inflation in Japan suggest we're around 3 right now. Is it correct to have slightly negative interest rates in the short end of the yield curve? Like, that's clearly going to be debated. They have a new governor coming in April, right? So the new governor, it kind of, actually after what happened today, it's got to be much easier for the new governor to really do something, because in a way, a really difficult part of the job has been done today. Getting started.
So yeah, I agree. And you said big deal. I'll say big deal, and maybe you're saying that too. But when we think about the yen and the move that it had made over the previous 9 to 12 months, that was a 3 standard deviation move against the dollar. Typically, when you see the yen strengthen like this could actually be seen as some risk aggression, risk on. But frame this, because obviously it's doing this for different reasons than it has at other times.
Yeah, like the whole correlation between equity markets and the yen is out of the window. Like, the relationship that people were used to from 2008 and other kind of crisis episodes has not been working at all this year. So we have inflation in the world. Inflation changes everything. All those correlations were based on no inflation, right? And we have inflation, even in Japan. So we have to just get used to the environment being totally different. I think also we have so much talk about, Fed pivot. Even if the Fed is going to slow down the pace and so forth, we're still going to be in an environment that is not zero interest rates, right? And this is going to be a global thing. And all the trends that were predicated on zero interest rates, they're not going to come back anytime soon. And today's news is just reinforcing that.
Yeah.
So let me ask you, the yen carry trade, which has been gigantic for a really long time, is that, is there a rush to the exit? What happens to that trade now, or is it still enough room there to do it?
When I looked at the price action today, this is literally what I wrote to my clients when I just observed what was going on. The carriage trades did not do very badly today. It's very interesting. That actually tells me that, EM carry, those type of things, I don't think they are subscribed to. Like, it is different from 2007 when there was a lot of carry trading in currency markets. People have been doing other things, and the price action today tells me that people don't have those trades yet.
All right, Jens, so bringing it back to some of our viewers who, again, this is a bit wonky for me, too, and I'm learning. I appreciate it. What does it mean for stocks? Because what you just kind of described was global stagflation, and Japan has finally joined the party, which basically puts just the hammer on the nail that 2023 is going to be a stagflationary environment.
So I think in Japan's case, right, they have been looking at the evidence, more and more inflation, but they've made so many mistakes over the last 2-3 decades about raising interest rates too early that they just didn't want to make the same mistake again, right? And they are very late to the party. So if they move interest rates from slightly negative to +1, is that going to kill the economy? One thing I thought was very interesting in the equity market in Japan today was that banks loved it. Banks loved it, right?
Well, they love them in Europe too, right?
Yeah.
If you think about every
but it's like it's not a typical like, oh, it's just going to be a catastrophic recession. Actually, there's some parts of the stock market that actually like this type of normalization. So I don't think it's like uniformly bad. If they overdo it, it will be bad. But if they do the correct amount, it might not necessarily be bad. Certainly not for Japanese stocks. I don't think so.
Jens, thank you for coming by. Welcome back to the
You're
NASDAQ
welcome.
here on set. Jens Nordvig of Exante. A guy, we were noting the bold moves, not in the equities market here in the United States, but certainly in yields we saw a move, in currencies, and definitely in commodities, which you pointed out on our call today.
Yeah, and gold and silver. And what I find fascinating is another way for banks, central banks, to intervene. Obviously, we saw Bank of Japan do it with their currency a while back. Now we're seeing with interest rates. But I think all roads lead back to gold and silver. And very quietly, you've had this stealth move in silver from the high teens to where we are now. And gold, as Danny Moses, by the way, is just texting me, chart looks fantastic. And his words, not mine, but it's gold's time to shine now. And I happen to agree with that. So you're seeing gold and silver start to, I hate the term, but I'll use it, decouple from crypto. And I think that's a really healthy sign. I think this gold trade has legs here, Melbs.
It's disappointing that so close to Christmas, Guy was saying gold and silver when he could have gone Burl Ives and said silver and gold. But anyway, gold's rallied 12%, and this is a perfect environment for gold. Everything the BOJ is doing will trigger gold, and you want to own miners in this environment. They have a beta of 3 times, and I think if you think about the world, and one thing that Jens said that we shouldn't underestimate, we all think that yields, or a lot of people think that yields are going to go lower in the long end because of what's going on the economy and pricing recession. I mean, he just said this. Japanese investors, especially in U.S. mortgage-backed securities and some of the other asset-backed securities around the world, the Japanese buyers are the biggest ones in the world, and this is something, I think, upward pressure on rates. And if you look at European sovereign yields, Spain, Italy, even Germany are back near those highs when we were at 4.25. Watch out for this. I don't think yields are going straight down.
Yeah, and I guess my only point in the question I had for him is, like, again, I mean, we're in a lower growth environment. We spent a lot of time in the show talking about what the headwinds of growth are in 2023 with China here. And if global rates are going higher in a way that we haven't seen in just a long time, that's going to weigh on equity valuations. So to me, like, look at the weakness that we've saw with just the spike of 20 basis points in the 10-year in the last couple of weeks. I mean, some of these tech stocks, the ARC complex, those sorts, they look like they're ready to just take a dive, and maybe they wait until January, but it seems like they're going to overshoot to the downside, and that's happening at some point early next year, and largely a function of rates and valuation.